Let's focus on the inflation story from a bit of a different angle this morning. It is inflation day in the US, and expectations are for a 6.8% jump in CPI year over year. But after the big jump in inflation data last month that shattered consensus forecasts, Mark has been writing about this quite a lot, and he wrote, "Bizarre that we listen to economists on this issue," adding that they've underestimated 7 of the last 8 US CPI prints, and yet their expertise is still guiding people in markets. Here to defend the Economist position in the red corner, if you like, is from Panmure Gordon, Chief Economist Simon French, Mark, of course, in the yellow corner, as dictated by their tie colours. Simon, very nice to have you with us. So what is your sort of best defence of why economists get the number wrong? Sure, they've been forecasting inflation's been on the rise, but the numbers, it seems to be that the economist community is constantly underestimating how high inflation will go.
Yes, I'm going to approach this in 3 breakdowns. The explanation directly to your question, which is that as pass-through from input prices through to consumer prices has been historically unprecedented. This has come through because of the strength of household balance sheets at rates we have not seen before. And whenever you're modelling inflation, you take your input prices and you assume how much risk sharing is going to be taken through corporate margins or passed directly onto consumers. This has been unprecedented how quickly it's been passed through, and I think it's the explanation. So issue 1 on why we've undershot most of the last 6-7 months, as Mark correctly points out. Then I'll give you the context as to why, perhaps just picking up on some of Mark's written word. A lot of economists don't do forecasts month on month. They do it quarter on quarter. And actually, most of my clients don't really trade on 10 basis points, 20 basis points of an inflation print. They actually want to know what the overall trend is and also the policy reaction. And the trend has been up, and the policy reaction has been benign, which is one of the reasons why economists haven't been beaten up by our clients, even if Mark's probably going to give me a couple of right hooks at the moment. And I'm also going to sympathise with Mark in terms of a couple of areas where I do think the economist profession is worthy of some criticism. And I do think that we've had that faster pass-through that I spoke about, and we probably should have known a little bit more that it was coming because of the strength of household balance sheets, the ability to pass through. The second criticism, of course, is I've been chatting with you for the last 6-7 years on this show, and if I'd been always to the downside on inflation, to the downside on interest rates, that would broadly have been right because the last 6-7 years have been that kind of environment macroeconomically. And I do think that there's been a bit of a bias has been forced into the economics profession as a result of the experience of the last 6-7 years.
OK, Mark.
Simon, good morning. I'm a little bit upset because they are such great answers that you haven't given me an obvious rebuttal here. But I do think the unprecedented corporate pricing power is a really important dynamic and would have been hard for economists to identify. And I think it's glad you raised that one. I think, though, the last point you named about the change in dynamic, that we've gone from a world where there was these great disinflationary pressures to great inflationary pressures that are possibly underestimated. My issue with why we haven't picked on that sooner is the fact that, that's all we've been talking about this year. If we haven't been talking about inflation, we've been talking about supply chains, labour shortages, the energy crisis, climate problems. They all go into the inflation problem. How do we fix this going forward? I am worried that we're going to fix it just at the point that we go past the inflation threat and we go back into a disinflationary world, and we're going to get it wrong the other way for a year.
Well, I like that example because, I mean, just before I came on set, I've been carefully following the cricket developments in Australia, and the biggest criticism you've put as captains in cricket is they go chasing the field. They put fielders where the last ball was hit. And you're absolutely right. That is the risk now, that as inflation is probably going to peak over the course of the next few months, certainly in developed markets. Will that be the moment where those assumptions on pass-through start to be updated, the bargaining power of labour starts to be updated in people's models, and you get a systematic bias to the upside, just as you've been doing a systematic to the downside? So you're unhelpful to investors on the way up and you're unhelpful to investors on the way down. I think that's one of the reasons why, as a community, we've been reluctant to update what has worked for a long period of time, as I said in my final part of my answer, because there is so much noise because of a once-in-a-century pandemic that is disrupting the data at the moment.
OK, so I understand that wariness about kind of wanting to update your model just at the wrong time. I call today inflation day because you got the US CPI print, and as we discussed, it's like the new non-farm payrolls. The day kicked off with Japanese PPI beating economist expectations for the 12th month in a row. Now a full year of every month economists underestimating it. So I ask you, is there a chance of an inflationary spiral in Japan for the first time in many decades? And if you tell me no, why should I trust you given that economists keep on underestimating it?
Yeah, I think the first thing to say in terms of the trust in the economics profession is it's a really important point, not just for private sector economists, sell-side economists, but for central bankers around the world who are guiding the policy reaction to this. And this is one of the reasons why we've seen Jerome Powell move on from the conversation on transitory. Because actually, I still think the institutional view, and you mentioned the Bank of Japan, is that there are some big structural deflationary forces that will reassert themselves after the pandemic has eased. But I think that talking across markets experience, your experience, investors' experience, seeing month on month higher and higher prints is unhelpful from a credibility standpoint. And I think that's the absolutely fair criticism. And actually, I would argue that you and others who have laid that challenge down have got the reaction from Jerome Powell. He's moved on from transitory, even though he believes in it, because he sees that arguing with the market doesn't actually buttress his credibility.
Simon, I've been thinking back to when I used to be an analyst for a bank many years ago, and I haven't done that job for a very long time. But I remember at the time there were some people who were really good at telling you everything there was to know about a particular industry, but they weren't that great at picking a price target. And there were other people who were great at picking a price target, but didn't fill you with great confidence in conversation that they really knew what was going on in maybe they were more across the market activity, the more short-term market activity. Do economists fall into different camps when it comes to that? Is that another dynamic to be aware of?
I mean, your industry experience is really valuable in providing that question, because you're absolutely right. Most of my clients, most of the clients for economists across the industry, want you to challenge their thinking. They really, I've never, in the 7-8 years that I've been at Panmure Gordon doing this job, had a client ring me up and criticise me for a particular quantitative measure forecast that I've put out. But they will, I think, stop picking up the phone, actually, if I don't challenge them from an intellectual standpoint. Give them a second, third derivative of the inflation story to think about in terms of sector reactions, behavioural reactions they perhaps haven't thought of, because they're trying to stress test their investment portfolio. And they want an economist to come in and tell them why they might be wrong. And I think that's perhaps the more valuable function than getting the inflation forecast right down to 10 decimal to 1 DP.
Simon, my final question is, are you sure you're an economist and not a diplomat here? Because I noticed you've countered with some very nice flattery to both Anna and I. You've given me credit for Powell changing policy, which I'm obviously going to run with that. And more importantly, you've given exceptionally insightful answers here to some of the challenges to the economist profession. But being serious, I think there's a chance here for you to have a small attack at markets. Following on from Anna's point, as you say, economists aren't incentivized to keep on updating their forecasts month to month and to get those consensus forecasts on Bloomberg, on Reuters, or any other service, perfectly correct. So the incentive is not for those forecasts to be perfectly accurate. And yet, in markets, we cling to them. We cling to whether it's a beat or a miss. Most traders don't really understand the underlying economics. They just go, look, the number beat. Look, the number missed. So how can we do better about this in markets? What's the solution to fix that problem?
Not to put as much weight. I think this is, I'm going to perhaps flatter you again. You can use it at your end of year review if you want, Mark. The real challenge is not to listen to economists as from a perspective of exact precision on the print. And particularly right now, and I'm on record as having said this throughout the last 6 months, consensus is going to be a particularly poor guide given the amount of noise coming out of the data when there are unprecedented reactions in terms of pass-through. Balance sheets don't look like anything we've seen at the end of a recession. They look much more like the top of cycle. Given that, you should look at consensus picture for at least another 6 to 12 months and take it with not just a pinch of salt, quite a big mountain of salt, I would argue.
An extra large spoon of salt. Thank you so much, Simon. Really good to see you this Friday. Thank you for coming to talk to us and helping us understand a little bit what's going on behind the scenes when it comes to inflation forecasting right now. Simon French joining us there from Panmure Gordon.